not a lot to say here because we haven't made any changes since the last episode. So where we did some restructuring in fixed income. So I mean, and the reason we haven't made any changes, I think we're reasonably well positioned for how things are and how things are evolving, which is to be diversified. We prefer high quality stocks and bonds because in these uncertain times, that's probably what you want. You do pay for them sometimes in terms of stocks valuations can be a bit higher with quality stocks, but if there is fallout, you would expect them to be able to work through and come out the other end okay. So we like that. We've got some emerging markets in there. We've got lots of mid and small caps overseas. We've also got a lot of mid and small caps in our Australian stocks, which gives us broader exposure and again more diversification. When there's a lot of risks out there, but equally, I mean, we talked about growth numbers in the US. If we were to see GDP growth of 4% plus, gee, that'd be something. They're big numbers for a big developed economy, not coming out of a COVID or a deep recession. So that would be something. And then of course you've got AI, which will be a disruptor, but it'll also be a massive opportunity. Think about what AI could do for profit margins. For example, right? Yeah. So anyway, diversification is important for us. We're overweight real assets because we think that's an area that gives you obviously some diversification from equity markets, but also it's likely to be a beneficiary of the AI market through infrastructure, data centers, and other means. And then again on the fixed income side, we've as we spoke about last time, we've moved into a fund that's a bit more active and that will take opportunistically positions in high yield. But most of our fixed income exposure is high quality assets because again we think that's where to be. And mostly we have an overweight position to floating so that we don't have interest rate risk as much interest rate risk over the long term. So that's kind of a snapshot of where we are on the tactical portfolios. We did drip feed a little bit more broadly across the various growth assets, not all of them, but a broad sample of them. But we still remain a little bit underweight growth, both in strategic and in tactical. But we're getting much closer to neutral, and we've got a big enough weighting so that if markets do continue to run, we'll do pretty well. And the portfolios are performing well. So and you've heard Jonathan talk a little bit about some of the asset classes that you like, your emerging markets and your small caps globally. And of course, we've talked about fixed income. So our portfolios are positioned well for a lot of these themes.